So we've spoken about assets, we've spoken about liabilities, and we've spoken about equity. Now that's basically the balance sheet. So the question is, what is income? My name is Jacques Taljaard, this is Taljaard Accounting Services, and by now you should know what my channel is all about. But if you're new to my channel, you'll find topics of accounting and tax and how to run a business or business management specifically within a South African environment. Today's topic is income. What is income from a business point of view? Now, where do we start? Again, we start with the definition of income from the International Financial Reporting Standards, and their income is roughly defined as an inflow or an increase in economic benefits by the increase or the accumulation of assets or the reduction of liabilities which have a net increase in equity other than contributions from equity participants. Again, these definitions have a lot of big words, but because I'm a nice guy, actually I'm kind of like a superhero for you. Let me explain what these topics are, what these big words and these concepts mean. First thing, inflow of economic benefits. You should know by now, if you've watched my videos on assets, liabilities, or equity, or the financial statements, or the income statement, you would know that economic benefits typically refer to money, right? So your economic benefit is typically money. So the question is then, why don't you know what economic benefits is, right? Oh, there's one more aspect in the definition that I didn't mention, and that is the inflow of economic benefits during the accounting period. So the next option is the accounting period. When is the accounting period? For companies, it's fairly simple. It's the financial year. For individuals in South Africa, your income is related to your tax year, which is from the 1st of March of one year until the 28th of February or 29th of February the next year, the last day of February. Unless you are born and unless you die, then it changes. If you are born, it's from the time you are born until the end of the financial year, which is February, and if you die, it's from the 1st of March until the date in which you passed away. And those are the exceptions to the rule in individuals' cases. But for companies, it's the company's financial year as registered with the Commission of Intellectual Property and Companies, right? CIPC. Alright, so those are your financial period or accounting period. So it's the inflow of economic benefits during the accounting period, which means an increase in assets essentially. What are you doing? Nothing. Okay. It's an increase in assets essentially. So that could mean donations. It could mean a revaluation of your assets. In other words, you've depreciated an asset and all of a sudden your asset becomes more valuable, or you've bought shares in a company and all of a sudden these shares in this company becomes more valuable. So it's an increase in your assets, it's interest that you receive, it's all kinds of stuff like that. So those are all increases in assets. But it also means a decrease of liabilities. Those are also options that could become income. And a decrease in liability is usually when a liability is written off. So if you owe a company, say one of your creditors, a large amount of money, and they've been leaving interest on that, and all of a sudden they say, alright, don't worry, just pay the capital, we won't pay your interest. That interest that they write off, or you won't have to pay interest, that interest that you write off, that's considered an income in your case, and you have to report for that and pay tax on that. So an increase or a decrease in liability is not necessarily when you pay a liability. It's a decrease in liability that doesn't necessarily mean you physically paid the liability. It's the inflow of the economic benefit as a result of an increase in assets or a decrease in liability. So increase in assets, money that's been paid to you in terms of an invoice, so that's an increase in assets, right? A decrease in liability is someone else that pays the liability on your behalf. That's an increase in assets. The principle is it increases your equity, right? And I've just spoken about equity in the last video. So equity is being increased, and that is essentially then what your income would be defined as. Now, the exception to the rule is contributions from equity participants. In other words, contributions by shareholders, the shareholders' contributions, members' contributions, permanent investments of a shareholder into the company. Let's say, for example, initially the shareholder, as I spoke last time I've spoken about member loans, shareholders loans in my liabilities and equity video that just passed. When a third option is for an individual to actually invest funds permanently into a company in terms of a capital contribution, right? Which means they never expect to get that money back. That money stays in the company, and this would technically comply with the definition of an income. It's an increase in economic benefits. It's money they physically paid into the company, whether into the company's bank account or by buying assets on behalf of the company and just registering those assets in the company's bank account directly. So the principle is these types of contributions would increase the assets and would then essentially increase equity. But according to the definition, that would be considered income, but that would be inaccurate because it's not income, it's a capital contribution. And so the definition specifically excludes those contributions. So you're increasing your equity by giving assets in where there's no liability involved or liability linked in. But it's not income per se because it's a capital contribution by the shareholders. And that is why then it's exempted from the definition. And so that's income. I've spoken about income before in this video right here, which I will link up one of these two sides up here. I've spoken about income before in the income statement, and I've now given you the definition of income. But the question is, how do you generate income? Well, if you're an employee, usually salary, right? If you're an investor, usually investment income such as interest and dividends and capital gains. But if you're a company, how do you generate income? And that is primarily through sales. Generate more sales and you will generate more income. It's simple as that. The primary option for, or the primary component of income is usually sales. Now there are a couple of technical other opportunities available, but they're technical and usually specific. If you are not sure whether this specific definition complies or applies to your transaction, pop me through an email, explain it through, and then I'll let you know whether it's an income or no liability or whatever the case may be. But in general, the principle is this is the application, and sales would be your main income. Income associated with companies are usually turnover and then interest received, finance income. In some cases dividends as well, or non-profit organizations, primarily donations. But those are the income options available to you, and as a result then those would be income. My name is Jacques Taljaard. This is Practitioner Accounting Services, and I hope you have a great weekend.